Hey everybody, welcome back to Whiteboard Finance. My name is Marko and I'm here to help you master your money and build your wealth. So the last few videos I've done have been on the laptop, so this one I decided to bring back to the whiteboard. Today we're going to be talking about investing 101, investing for cash flow or investing for capital gains. So these two things are not mutually exclusive, you can do both. However, I'll explain why it may behoove you to do one over the other and choose that for your long-term investment strategy. So in this video, I'm going to explain what investing for cash flow and investing for capital gains is and which one is best suited for you and your goals. Stay tuned. So the first one we're going to talk about in this video is investing for cash flow. So investing for cash flow is pretty much when you have an asset, let's just use a rental property in this example, and every month you have money coming in from it, okay? It's an asset that you've invested in and you're hoping to get consistent, predictable income from it, every day, every month, every year, every quarter, whatever that asset brings in and whatever that time period is. So the goal of investing for cash flow is to basically build up wealth steadily over time. And ideally, what you want to do is you want to reinvest the money that this asset is throwing off and buy more assets. That way you can keep building more of these. Let's just say it's a rental property. And then now instead of one cash flow stream, you have two. And that way you can invest these two back into buying more, and you compound, so on and so forth, okay? That's how you build massive wealth over time. So if you want to look at some examples, obviously we talked about, owning income producing property. You can do that with, real estate with a single family home. You can own real commercial real estate. I know that seems like it's unattainable for most of you, but I do have a link in the description below to Fundrise. With just $500, you can invest in actual real estate. Another example would be dividend stocks. So there's a lot of good dividend stock channels out there. I'm going to give a shout out to my buddy PPC Ian. He's a great dividend investor. So similar concept, let's just say we're investing in 3M. So if you guys are familiar with 3M, their ticker symbol is literally 3Ms. They're the ones that make paper products, consumer goods, things like that. They've paid an excellent dividend, over the last 25, 30, 40 years. I believe they're a dividend aristocrat. So say, for example, you have one share of 3M and it throws off a certain dividend. Let's just call it, I don't know, $1 a month. I'm just making this up as I go along. You can take these dollars and reinvest them and buy more shares of 3M, and that way this number goes up over time and your shares go up over time, and it just keeps compounding. That's just another example. Another example of creating cash flow is a promissory note. So you can actually become the bank. So say, for example, you have a buddy that knows how to flip houses and he's looking for a short-term loan. So he says, hey, I'm going to buy this house for 30 grand. I know I can make X amount of dollars on it. Let's just say I'm going to sell it for 100. You know what? But I really need, I need 15 grand to get started. So what you can do is you can actually become the bank and you loan the flipper this $15,000. He can pay you maybe a down payment on that, and then you can actually create a monthly stream of income off the interest. Say you're giving him a loan for, 8% because he can't find it anywhere else, and then boom, you've just created a stream of monthly income for yourself. So that is investing for cash flow. So who is this best for? Investing for cash flow is probably going to be best for people that are looking to either become financially independent. So let's call this financially independent, or people that are investing for their retirement. Okay, so why these two things? Well, typically, let's talk about financial independence first. So financial independence is basically when your income is greater than your expenses. So let's go back to that real estate example. If you have 10 cash flowing houses that are all paid off and they're each bringing in $1,000 a month in profit, again, they're paid off, keep that in mind. You have $10,000 of cash flow. If your expenses are $9,000 a month, congratulations, you're financially independent. You don't ever have to work ever again if you don't want to. Same thing with retirement, okay? Retirement is pretty much for people that, they hold dividend stocks. They can hold actually real estate if they're in a self-directed Roth IRA or if they're in a self-directed 401k. You can invest in pretty much whatever you want in that case. However, the reason dividend stocks and cash flow is interesting for retirement or appealing for retirement is basically because these people, they know that they need a certain set amount of income coming in, and they're getting that through these assets. So that's pretty much who cash flow is going to be for. Now, some of the pros of investing for cash flow is if you do it correctly and do it properly, you can create massive amounts of passive income over time. So you can become financially free, like with a couple of investment properties or a lot of dividend stocks. It just depends on what you're investing in. Also, the pro to investing for cash flow is that DRIP program that I talked about with the stocks. So the DRIP program just stands for Dividend Reinvestment Program. This isn't necessarily a pro of just cash flow investing, but DRIP programs are powerful because you can take that 3M stock that I talked about, and instead of cashing out the dividend, you can actually just invest those dividends back into buying more stock, and that way it just compounds over time. Now, some of the cons of cash flow investing are that you can get married, quote unquote, get married, quote unquote, fall in love with some of these underlying assets, even though the value of the underlying asset is going down. So perfect example is, let's take that 3M stock, for example. Let's just say today it's trading for, I don't know, 150 bucks a share. I just made that up. Now, you've been investing in 3M, it's been throwing off good dividends, you've been reinvesting it back into buying more shares, you're making more, and let's just say 3M gets hit with a catastrophic lawsuit and the intrinsic value of this stock, instead of being at 150 bucks a share, it gets slashed, and say they go into deep bankruptcy and they can never recover, and the share price is worth $5, right? Well, you've been investing, all these dividends back into more shares that you inevitably fall in love with 3M, and you never consider selling it over time as the stock price is dropping. Same thing with the rental property. You can kind of get married to that rental property because it's been producing income for you. However, the value of the real estate hasn't appreciated. Say like you're in the hood somewhere, if you're in Cleveland, Detroit, whatever. There's no appreciation on the real estate. However, the cash flow is good. So those are some things that you have to consider about the actual value of the underlying asset, okay? So let's move on to investing for capital gains. Okay, so capital gains investing is pretty much that old cliche of buy low, sell high. So this is pretty much buying something, we'll just call this capital gains. This is pretty much buying something for $1, selling it for $2, okay? Buying at X, selling it higher at Y, okay? It's your typical buy low, sell high cliche, okay? The goal of this is to acquire something that's either undervalued or perceived to be undervalued at the time, and then obviously selling it for a higher price at a later date, okay? The difference between that is your capital gain. So if you buy something for $100 and you sell it for $200, your capital gain is just the price that you sold it for minus the price that you bought it for. In this case, it would be $100, okay? So capital gains are pretty much, to give you a few examples, you can, flip a car. So I'm gonna draw a terrible car here. It's actually pretty good. Here's some exhaust for all the electric vehicle lovers. There's some nice exhaust right there. So you can buy a car. Say you find an undervalued car, you buy it for, I don't know, $6,000, sell it for 10. That's a capital gain of $4,000. Another example is buying stock. Buy low, sell high. So you buy the 3M stock at, let's call it $150 a share. Next thing you know, they came out with an innovative product. This goes up to $170. Boom, your capital gain is $20 times the number of outstanding shares that you may own. Same thing with flipping a house, so on and so forth, okay? So who is capital gains investing best suited for? So this is for people with nose for a deal. Like, you know how to hunt on Craigslist, you know how to find an undervalued stock, you know how to find a mom and pop truck that's being sold on the side of the road for significantly less than it's worth. Basically, people that are going to find underperforming or undervalued assets, you have to have a nose for the deal. Or if you are a real estate investor, or if you're a fix and flipper of something, you have to know how to force the appreciation in value. So say, for example, you find an apartment building. Okay, apartment building's got 100 units, 100 dwelling spaces, 100 units is what we call it. And say each one of these units is bringing in $600 a month. However, you realize that it's an up-and-coming neighborhood, you improve all the kitchens, the bathrooms, you change the stinky carpet to hardwood, and you get these rents to, I don't know, $850 a month. you just now created $250 times 100 units in value per month, which will increase the net operating income of the apartment building, which will then allow you to sell that asset for a lot more money than what you bought it for. So that's what we call forcing appreciation. So some of the pros of capital gains is that depending on your asset type, you can make big profits in a little bit of amount of time. So say, for example, you find that car on the side of the road, buy it for $6,000, clean it up, detail it, fix a couple parts, boom, you just made $4,000 when you sold it for 10, okay? Some of the cons of capital gains investing is that it can lead to speculation and loss of money if you're wrong. So this happens very often in the stock market, especially with traders. That's why I don't day trade. Day trading, you can be very profitable, but you can also lose a lot of money. Everyone thinks that they're a genius. They know they have a crystal ball. They know exactly what's going to happen with the 3M stock. But in our example from before, instead of it being at 150 a share to 170, this actually goes from 150 to 130. And guess what? You just lost $20 a share times however many shares you have outstanding. Okay, makes sense? So it could lead to a loss of money. Now, how I want to conclude this video is that what I firmly believe in is that if you're young, if you have capital gains or cash flow, let's just call these two different strategies because they are. Okay, if you're young, it just depends on how you want to approach this. I think that you have time on your side when you're young, so whichever way you choose to invest, you should stick with that and invest more money into that strategy. I feel like a laser-focused strategy is going to get you better results than kind of just pecking like a chicken. It's like, oh, I'll do a little bit here, I'll do a little bit there, I'll do a little bit here. That's not going to compound your results. It's not going to compound your gains. If you get into a underperforming stock early and you ride it out and it's a successful company like Amazon or Apple or whoever, McDonald's for example, you can see huge amounts of capital gains, okay? And those stocks, well, McDonald's at least does throw off some dividends and you can actually reinvest those dividends as well. If you're investing in real estate when you're young for cash flow, for example, if you build up a couple properties, put 20% down payment on each of those, you actually pay one off at a time. Now you have the full profit from one property paying off the other. Now you have two fully paid off properties and so on and so forth, and you can acquire more and more. So I just think that whatever you choose to do, be decisive and choose early, okay? It's not investment advice, it's just something that I would do. So I hope you guys got value out of this video. This is Investing 101 in 2 different investment strategies. Obviously, this doesn't cover every single investment strategy in the world, but these 2 categories cover a lot of them. So I hope you got value out of it. If you're interested in my free investing guide, click on the link below. It's basically just an objective summary of a bunch of different investments that you can make, and it took me days to make that PDF, you guys. So please download that. It's absolutely free. Thank you so much, everybody, and have a prosperous day. Man, I used to remember flipping those Pokemon cards, man. Didn't pay any taxes on that. I'm just kidding.